Hey, Twitter followers, Facebook friends, LinkedIn connections, traders from around the world. Thanks so much for reaching out to me today. It's been another incredibly busy week, thanks to you guys. So obviously, the market is down kind of big, and again, emails, text, tweets, whatever social media you guys use has just been absolutely going bananas the last few days. So I'm going to make a really quick video for you guys. It's going to be pretty introductory. Is that the right word? Introductory? Introductory is going to be simple, and I'm going to help you understand the basics of what I'm looking at regarding the market. So make sure to watch the video. Let's go ahead and hop over to the charts. I'll check it out and hopefully answer your questions. If you have any questions for me, make sure to let me know. All right, I'm hopping over to the computer. Let's go. All right, we're here on the charts, and I want to show you visually what my world looks like in regards to trading, the stock market, things like that. First and foremost, just really quickly, I want to let you know the video is going to be just a tad longer than like a 2-3 minute video. Watch the whole video if you have any questions, because I'll probably answer them in this video. And this video is going to be going over a little bit of different various groups and demographics of my friends and clients and customers whom I deal with on a day-to-day basis. So first and foremost, this is a chart, a visual representation of the Dow Jones. Now, this is not the Dow Jones exactly. This is a stock that trades the Dow Jones. You can't just easily go out and trade the Dow Jones, right? The Dow Jones is an average. It's an index. It's an index and an average of 30 other companies, and this is a representation oftentimes of the economy of America, if you will. If I had to make it really broad, right, I would say if the Dow Jones is high, the economy is going good, and if the Dow Jones is low, the economy is going bad. So just a really quick reference. This right here, this is 2007, 2008. Right, market's crashing, everyone's scared, everyone's worried. Well, this is the last few years, and as you can see, the Dow Jones has not only recovered from its 2007 highs, but just absolutely scorched them. It has just gone really much higher than anticipated. Well, I say anticipated. Once it broke out that level, it just continued higher. So anyway, what to do now? Well, you saw the title of the video. Is my 401k IRA safe? Let me break you guys down into a few age groups, and pretty much I'm going to say anyone under 30, which is including me. If you're under 30 and you're watching this video, and you've been investing in an IRA, I don't care if it's a Roth IRA or traditional IRA, or you're in a 401k and you're doing longer term market stuff, don't worry about this, right? Don't be actively trading if you're under 30. If that's not your job or your passion or anything, it's not going to matter. Okay? If you're under 30 and you're investing, don't buy and get worried about the pullbacks is what I'm saying. So even if the market does this, right? If you're under 30, you should be buying all the dips that you can. If the market pulls back 10%, add some to your 401k. If the market pulls back 20%, add some to your 401k. If the market pulls back 30%, add some to your 401k, because over time, if you're under 30, by the time you quote unquote retire, okay, 55, 60, 65, whenever, you're going to have a really big nest egg, and that's 30 years away, maybe even longer from your retirement. So bottom line, if you're under 30, don't let these market fluctuations scare you. I really would. And again, just for all my SEC reasons, I'm not licensed. If you want to speak to a licensed representative, we have plenty who are here at Real Life Trading, but I'm not one of them. I just simply trade. I teach people what the market is and how to use it and how to make money with it. If you're under 30, I would personally not worry about this market at the moment, right? Even if the market does this, right? Market, well, okay, fine. You're 32 and the market's at an all-time low. Start buying like crazy, right? You get the point. Don't worry about the selling, because you don't have enough money in your account right now for the majority of you out there. You don't have enough money in your account for a 10% or 30% or 50% correction to do anything, okay? So don't stress out about it. If you're 30, just start buying the dips. Don't worry. If the market goes down, buy some, add. Now, let's talk about the people who are out there from 30 to 40. And then after I go through the age groups, I'm going to talk about my perspective on what I think the market will do. Okay, that's what I'm going to get to at the end. So for my traders who are 34, and again, this is my educational opinion, you might have a little bit bigger of a nest egg, right? Maybe you have a little bit bigger of a 401k IRA, and so some of these swings can have a $5,000 or $10,000 impact on your investment portfolio, your size of your account. In this situation, I do think it's imperative to begin to learn a little bit about supports and resistances, because I'm getting a lot of traders out there saying, Jeremy, should I sell now? Should I sell my position? Well, really, if you're 30 to 40, you sell at the highs. Okay, so there's the highs, and you start buying some of the dips. So if the market is high, your ETFs are high, your mutual funds are high, you're making some profits, you can see that, oh man, this is a price that we've run into many, many times before, and we're pausing there, and this is a great place for me to lock in some profit, then do just that, right? Lock in some profit, sell and get some profit, and on the pullbacks, begin to buy, and don't really stress about it that much. And if you do stress about it, you can always learn how to help and prevent any decreases in your account by buying what's called an inverse ETF. So it's literally something that you can buy that goes up as the stock goes down. So that's what, for my 30 to 40 year olds out there, if you're really concerned about, oh man, the market's going to fall, it's going to tank. Well, if you have an IRA or 401k, you can add a little bit of this inverse ETF, which is also called a tail. And I'll give you one of them. It's ticker symbol SDS. So the SDS goes up when the S&P goes down. So you can always buy these just as a protection or a hedge, just in case the market goes down. So just kind of keep that in mind. So let's talk about my 40 to 60, and this is kind of a big range of groups of traders. I agree. 40 to 60, that's probably my main demographics, that's the main clients and customers who reach out to me about their investing needs. And I will say that this is a good time for my 40 to 60-year-old traders to begin to consider going into a little bit of a cash position. Or again, this is an educational opinion of mine. And when I say cash position, when a stock or a market that you're trading is at an all-time high, which we are, all right, we're at an all-time high right now. Cash is never a bad thing. So if you're sitting in cash, letting the stock hang out and do this, right, being in cash is not a bad thing, because the market's trading sideways, you're not getting a lot, and just in case it does roll over, you're protected. So you can take some of that cash and go buy something that's low, right? So for my 40 to 60-year-old traders out there, if you want to be in cash or you're kind of concerned that the market can start rolling over, go look for companies that you like. Right? Go look for products that you use on a day-to-day basis. Go look for companies like British Petroleum or Exxon Mobil, or some stocks that have sold off really, really nicely, and buy low, sell high. If you're going to be investing in stocks, that's a really, really solid rule. Buy low, sell high. It's going to be beneficial for you at these levels of the market, because realistically the market is high and you never go broke taking a profit. So if you always sell when the market's high and do your best to buy when the market's low, that's kind of a prudent thing to do in my personal opinion. Now, for my traders who are 60 plus, and again, this is probably my second highest demographics. And the reason I say this is because my traders who are 60 and over, like my dad was, these are traders who are really concerned about their retirement because they are retired or vastly approaching retirement, and they have a big nest egg, right? If you have a big nest egg, you have a lot of money in your IRA or in your 401k, or you're about to retire, and you might have a pension, maybe you'll have Social Security, right? People my age, we're not going to have Social Security. I realize that, but if you do, that's a benefit. Okay, and medical expenses are going to be coming up. There's going to be things around the corner that are going to be really, really scary. So if you are over 60, in my personal opinion, non-licensed opinion, my thought would be cash is king. Cash is king in a really, really powerful bullish market like we are right now at the top. We're at the top of the market. And here's what you need to understand. I'm going to get to this in just a second. Will we fall or will we not? That's going to really depend on how much cash is king. I had someone who just emailed me, honestly, who fits in this criteria perfectly, and goes, hey, Jeremy, I'm almost retired. I could retire right now, but I like working. I've been working for this company for 30 plus years. I have a pretty sizable retirement. He was giving me, he was sharing his numbers with me. He's like, dude, I'm mostly in cash right now. He's like, I do trade some things from here to there. If it's low, I buy low, sell high, but I'm mostly in cash waiting for some type of correction. Here's what you got to understand, ladies and gentlemen. In this particular market, a pullback is likely coming, but a market can correct in something called time or price. And this is important for you to know regardless of your investment acumen, time or price. So what I mean by that is, if the stock market, which is the Dow Jones Industrial, does this, so if we continue to trade sideways for another year or so at this market, we can have an insanely strong bullish thrust. That's absolutely possible, and in some form or fashion, I think that's probably what we're going to do. So that's the answer to your question. Is your 401k and IRA safe? More than likely. That's probably what I think it's going to do, because here's an interesting rule about the market. When everyone thinks the market's going down, that's probably when it's not going to happen. Okay? I know it sounds wild, but when I start getting all of the emails and the text messages in the Facebooks and the Twitters and the LinkedIns, the reason I'm making this video is because if a lot of people are freaking out, that's oftentimes the time when the market won't be that bearish. The times when the market won't crash will be times when, like in 2007, when the market likely will crash, is times like 2007 was like, oh man, this is time to buy, right? Buy, get in. There's, we're going up. So it's that's how it was in 2007, right? A lot of the analysts, a lot of the market out there, the colleges, universities, everyone was bullish, and it just rolled over, right? Now there are obviously some warning signals out there, and I will give you those warning signals now. There's something called a chart pattern. It's called a head and shoulders pattern, and here it is right there. This is a 2007 pattern. It's a head and shoulders. We came up and retested, and that is when we got the signal to go bearish. If this happens in the current market, ladies and gentlemen, let me just draw this for you really quick. You ready? All right. Notice the similarities. Boom, boom, possible. Okay, this is all hasn't happened yet. Come down. All of this has not happened yet. Come up. And if this happens, okay, this exact price, if that price happens, right, at this point in time, I want you guys to understand I'm a buyer right there. I'm a buyer. I'm okay, because I can also draw something else. I'll show you that pattern. But buy low, sell high. This will be another support. That would be approximately a 10% correction in the market. Very healthy, very needed, very common. Okay, a 10% correction, not a big deal. So I personally would be a buyer at that level, right? Buy the dips, buy low, sell high. The market is bullish. Buy the dips until it stops working. What do I mean by stop working? Well, I'm going to watch very closely if that happens. I'll be keeping a close eye on it, don't you worry. But then if this begins to happen, I'll let you guys know. And then I will come up with another video letting you guys know, all right, this is the time that we do need to start being a little bit cautious, being a little bit buying some insurance on your stocks. By the way, yes, you can buy insurance on your stocks, just like you can buy insurance on your house and your car. I'd be happy to teach you how. But I'll go ahead and let you know if that happens in the market. Real life trading, as far as a company is concerned, will just go absolutely gangbusters. We probably will get more customers and clients than we know what to do with if that happens, because that's when people worry. That's when people perk up, when the market's going down. When it's going up, everything is fine. But when things are going down, they freak out. And that's kind of why, unfortunately, this headline on today's video was so captivating to you, because a lot of companies use what I call fear marketing to sell their products. I don't try to sell anything. When I teach a class, there's no sales pitch. I just teach it because I love educating. I like being a teacher, and I don't have any sales pitches in my programs, my videos, my classes. A lot of people, a lot of companies, a lot of analysts out there, they will create sales marketing campaigns that are totally based on fear and you losing money. Right? So they'll say, is the Dow going to crash? You'll hear things called the death cross. The death cross is here. Be prepared. Rah! Right? It's a death cross. The death cross is just a moving average crossing over. It's the 50 daily crossing the 200. Now, granted, is that a little bearish? It can be. It hasn't happened in a long time. I'll tell you the last time it happened, which they're not telling you on the news, is back in 2010. That's the last time we got a death cross, and look what happened. The market just went absolutely gangbusters. So to wrap the whole thing up, bottom line is I'm going to be bullish until we get a pattern that looks like this, until we get something that goes boom, 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 break down, trade to this support level, which is going to be a buying opportunity, trades back up, and then this is very plausible from there. This is very plausible from there, and we just keep going up at some point. And then this is the most unlikely scenario, in my opinion. When I say most unlikely scenario, like I'm putting that at a very, very low percentage that actually happens. And if it does, I'll let you guys know. We'll be ready, and I'll help you trade it. And I'll help you protect yourself and maybe make some money on the downside, okay? But as of right now, that's kind of my overall thoughts. And I'm going to hop over to another ETF. This is the IWM. I'm not going to get really fancy with the names, but bottom line, this is the Russell 2000. Let me just kind of share with you really quick some similarities here on the daily chart. So just bear with me just a second. And this is the daily chart. I'm going to share some similarities with you and just kind of show you what I'm looking at. But notice, this is, again, a lot of traders were calling this a head and shoulders pattern. So something like this, and the stock broke down. And right here, everyone got bearish. Everyone was freaking out. But again, if you think about it, it went from 116 to 104. 116 to 104. That's a 12-point move. That's almost a 10% correction. And if you factor in the high up here of 120, that is a 10% correction. So that was healthy. So you guys ready for this? Boom, boom, boom. So it's a little bit smaller. Pulling back, I agree. It looks a little ominous, without question. But if we come again back to a weekly chart, and this time I'm actually going to pull up a moving average for you. This is called the 100 simple moving average. You'll notice that last time we did a very, very similar pattern, we bounced, and that's actually when real life trading was launched back in October 2014, and I was bullish that entire time. At this particular level in the IWM, stock pulls back, and notice the similarities of how this looks. Okay, where we are in relation to the 100 simple moving average and where we are on the scale of time. This was approximately October. We're in August right now, so we have most of August almost done. September, October, it's almost the same pattern, almost the same time frame. Bottom line, ladies and gentlemen, I'm not freaking out yet, and I don't think you should either. If you get a lot of the fear campaigns or the fear emails out there, feel free to email me. I'm happy to address it. If you really are that interested in actively trading, I'm happy to teach you how to actively trade. But otherwise, until some things really, really change in the economy, I don't think anything really goes down crazy until the elections next year. And that's, I think, when we might have some opportunities for some serious moves. But again, that's my overall thought process on investing in an educational standpoint. I do not have a license. I don't plan to get a license. I do not manage money. I don't plan to manage money. If you want someone who can do that, we have people that can do that. Otherwise, thanks so much for watching this video. I really appreciate it. You absolutely rock. And until then, remember, love life, live life, and trade. Thanks so much for watching this update, guys. You rock.